Hello, my name is Kojiro. Welcome to my channel, Good Vibration. Well, this video is the first of a series of videos that I will be making, which are some type of tutorial, and I will explain using my methods in trading. And well, this video is about how to spot successfully and effectively changes in trend, and I hope it will be somehow useful to other traders for insight or for in their analysis and in their trading. And I usually use the law of vibration and cycles as my primary trading tool, and I also use price action, and as you can see here, indicators and Keltner channels, sometimes Bollinger bands. I use volume, I use RSI, I use the ATR, the average true range indicator, and some other stuff which are secondary in nature, and I usually use them to confirm my trades, not as a primary tool for trading. So I'll be explaining how I do it. I want to share my experience, and maybe other traders can use it and have insight and in their analysis and everything. Might not work for everyone, because in trading, what works for someone might not work for everyone. But anyway, it might help learning new stuff in trading, other ideas or strategies of other traders. Okay, the first thing to know that there's going to be a change in trend is, you have a price action here, that's trending up. The first thing you have to do is draw a trend channel. It should be two parallel lines, and you have to verify that the channel is consolidated. And you can do this by at least you have to check the price touches at least 3 points of the channel, like one here, at least 3 points, and in the other side also 1, 2, at least 3 points. So that's the way to validate the channel, and it can be reliable, and that there's a trend in place. In this case, is an uptrend. You can see it clearly here. We have a validated, consolidated channel here. So the next thing you want to look for is you want to check for a break in the channel, like here. You want to check that the price action actually breaks through the channel and closes outside the channel. When this happens, there's a very good probability that there's going to be a change in the trend from uptrend to downtrend. So okay, again, this you have to check for the break in the channel, and that the price action closes outside of the channel. So almost always, not always, at least 90% of the times, when this happens, you have an uptrend, trend channel that is already consolidated, and the price action breaks through the channel and closes outside the channel, the next thing that will happen, and usually at least 90% of the time it happens, is it's going to go up to retest this level here, this top here. So it will, it will make what we know as a double top. This is the way double tops are formed, because this happens because momentum traders, most of the time they start buying. They want to keep on buying because they think the trend is going to go up, but it cannot go on forever. So as soon as it breaks here, most of the traders that enter late into the trend, they will try to catch this, the trend, because they think it will continue going upwards. So that's why this forms, and this is always going to come and to retest this level here. This is the reason why double tops form, and also triple tops, and they are reliable signs that maybe there's going to be a imminent change in the trend to the downside. So there are really three probable outcomes that can happen when the price action closes outside the trend channel, when it breaks the channel. The next outcome will be that this is the first one that makes it exactly a double top. Next probable outcome, it's the price action breaks through this level here, and closes up, the upside of this resistance level here. And the third probable outcome possibility is that it doesn't get there. It is short of getting there. And the three happen a lot there. And I'm going to show you how to identify when this happens, the actual change in trend takes place. So when it makes a double top, probably you're gonna go down. Go way down here. Same thing when it gets, doesn't quite get here to this level, to this resistance level, and goes down, change in trend. And the other one is that goes through, and then it changes the trend to the downside. So this is the start of the downtrend, so to speak. Here, three probable outcomes. And the way to confirm this three possibilities, well, if it's a double top, well, it's already confirmed by itself. But I'm going to show you how to confirm, extra layers with, a confluence of other factors that you can take into account before taking your trade, so you can be more, the trade can be more reliable. Of course, this is not 100%. There's nothing 100% in trading, but this is at least, I calculate, around 70%. It works around 70% of the time. Okay. So when it goes through this resistance level, you can use the Fibonacci extension levels to check that the trade is going to take place, to give it, more reliable signals to confirm the trade. And if you get short here, we confirm, you can confirm this by using not the extension levels, the Fibonacci extension levels, but the the Fibonacci retracements. These are the three options you get that I trade when this happens. So summarize it. First thing to do, have to draw the channel and validate it, and you have to check that this is a validated channel, at least 3 points touching here. 1, 2, 3 points. The next thing will be to check that price action breaks through the channel and closes outside the channel. This is the first sign that there's going to be there's a good chance that there's going to be a possible change in the trend. It has to close outside here, and from this point there are 3 possibilities. That it goes through the resistance levels, the stop here, that it gets right to this level, will make a double top, and the third one is that it gets short here and it doesn't quite get to this resistance level. And in my work, from any one of these 3 possibilities here, price can then change trend. And another important thing to keep in mind is, well, this point has to be, the highest point around here. It's gonna be, has to be at least the highest point around here. Price action, the previous price action, price around here, this level. Okay, well, let me show you this in using the bars. So the first thing you want to know when spotting effectively and successfully a change in trend is, as I said before, you have to draw a channel, and you have to check the channel is consolidated. And how do you do that? Because it has to touch at least 3 points. So we can see here, touches 1, 2, 3 a lot of times here, 1, 2, 3 a lot of times here. So this is clearly an uptrend. We can see here that, well, the price is going up. And the next thing we have to look for, or I look for here, is there's a break in the trend channel, like here in this case, and it has to close, the price action has to close outside of the channel, like here in this place. So this is the first signal that's telling me that there's might be a high probability that there's going to be a change in the trend. And well, the next thing I look for, and always what will happen, almost always, excuse me, is a retest to this level up here. Because momentum traders, they will almost always try to keep pushing up the price. They try buying and keep, even if it breaks outside of the channel, they will try to, try to keep on pushing the price to go up. So this is the first indication that the price is going to change its trend. The break in the channel and the price action actually closing outside of the channel. And this happens almost always. The retest to this level, in this case, well, it actually doesn't get quite to the top here, to the resistance level, and it gets short of getting there to the point, to the level there. In these cases, what I use is a Fibonacci retracement level from the highest point here to the place where the price action actually broke of the channel here, close outside the channel. This is the second thing I look for there. And then what I can see is that, well, it has to react exactly at one of these Fibonacci levels. If it doesn't react to one of these Fibonacci levels, I usually do not take the trade, because that's one confirmation I use. And we can see here in this case that price reacts to the 61.9 level here, you know, in this swing here, this impulse here. And the highest point here gives us the third thing I analyze will be other stuff if I have, you know, but here we don't have all the other stuff. For instance, the overbought levels in the RSI, the volume levels here, or, you know, some moving average crossing at that point exactly. Well, we don't have that. Or the Keltner channel or Bollinger band or anything that can help us confirm that, you know, that we can take the trade. I can take the trade with high reliability or high probability. So here, the last thing I always check for is the bars, like when used in price, as it is used in price action. I can see here that this high point here, it is actually a very nice bearish bar, because it's an inverted hammer which closed very low in the lowest third portion of the bar, and it shows a lot of force that is going to change. And it also, and the other thing here, it is touching the trend channel here, which acted as a resistance level here at this point here. We have like 3 or 4 things, and I always look for the confluence of several factors or several signs or signals that tell me that I can take the trade, you know, with high probability. If I have only 1 or 2, I usually won't take the trade. I wait for more confirmation. But in this case, I have like 3 or 4 things that are telling me the channel, the break in the channel here, Fibonacci levels, this support, this you know, channel here that acts as a resistance level there, and the bar, which is also always the last thing I check before I take the trade. So when I identify all these things, I usually use a stop market or stop limit order 1 tick below the bar that's signaling me that I can take the trade, the signal bar, so to speak, here. And the stop loss should be 1, 2, or 3 ticks above this bar here, at this place there. So this is the protective stop loss there, and then I take the trade. When price comes through this place and take my order, well, it starts going down. It will have been a nice trade. It went all the way down here. Somewhat kind of lateral here, range light, and then it goes down. But it's clear the change in trend. Change the trend to the downside, from the upside to the downside. And this happens all the time, many times in the market. You know, even intraday, or if you scalp, or if you day trade, or if you swing trade, position trade, it's always the same. The method works in any market or any time frame. Some other people prefer to put their stop loss here up above 1, 2, or 3 ticks above the highest point. I personally prefer to keep my risk low, so I always put it here, 1 or 2 or 3 ticks. If it fails, well, I move on to the next trade. But this is also okay to trade with the stop loss above here. And well, that depends very much on the risk tolerance of of each person individually. And the other way you can enter the trade is if you use a limit order, not a stop market or stop limit orders, a normal limit order, and you wait for the price to come back here, the next bar of the signal bar to come inside, and you can take the trade, enter the trade anywhere there, this red bar here, around here you can take to lower your risk, you know, for a lower risk. And well the risk there is the distance between, you know, the entry point and the stop loss. That way you can reduce your the risk. But many times you know, price action just starts going all the way down and doesn't come back. So many times you don't get filled, and the trade goes on without you. That's why using a stop market or stop limit order is better, but well, it has a bigger risk. And this will have been a nice trade, because it will be like, how many points here? 75. If you let it go all the way down to here, 42, 35 points, around 35, 33 points. Nice trade. It happens a lot. Let me show you another example. The 3 probable outcomes. Here we have another one. We can see here there's a clear uptrend again here. We have to check that there's a properly a channel there, and then I check that there's consolidation of the channel, and this is a validated channel. Then 1, 2, 3, 4, 5 points here, 1, 2, 3 points there. So this is an uptrend clearly. And well, this works for micro channels and bigger channels, macro channels. In any of those channels you can use this method. And in this case it makes a double top, because it breaks down lower here. And we have here a Fibonacci retracement, but it actually goes up. So we have to use an extension, because the resistance level will be here. You can see right at this place. But the price action, because momentum traders want to keep pushing up the trend, they move it up to here, this place here. But again, at this point here, this bar is not so, it's bullish, it's not bearish, so it's difficult to take the trade there, because you don't know if it's going to keep pushing up. So then it retraces again, as you can see here. Let me draw this little channel here, micro channel. There we have a micro channel there, small one, and it breaks out of the channel again, closes outside, price action closes outside of this one, goes up, you know, in this correction to retest the level, goes through it, comes back down, break this mini channel here, micro channel there, price action closes outside of this, breaks and closes outside of the channel, and then it retests again. It happens twice, in the big one and the little one here. And at this point we have a nice bar here. It closes below this resistance level here. This is an engulfing bar, very bearish, and It would have been nice that it closed outside the Keltner channel, because that's another confirmation I use. It closes outside the Keltner channel, but it clearly it didn't touch there, but it made a double top here. This point there, nice double top there. This is a nice double top there. Golfing bar, and this side we have clear rejection here from the channel as a resistance level there. And in the second, the second attempt, it doesn't go up, closes below this resistance level. So you can take the trade there. Stop loss 1, 2, 3 ticks above this place, which is the highest point, or above this one here, which is a little bit higher. Whichever you know, that depends very much in the risk tolerance of each individual trader. I prefer risk as small as possible. Some people want here, okay, it's no problem, it can be used here also. And entry 1 tick below this bar, red bar here, big red bar there, which is an engulfing bar, very bearish. 1 tick below, stop market or stop limit order, and off it goes to the downside. And you have to check this. This is actually exactly this point here. Let me show you something here. Oh, not this. Initially, it came down from here. This was the highest point. Break the channel here. So I had to measure from this point here. But it actually broke up. And when it broke up, we see a clearly rejection here at the extension level, because this will be continuation of this one here, of this Fibonacci retracements, and it extends 23.6%. And we see a rejection there clearly, and the Keltner channel there at this point here. And that's a clear indication that, well, it's rejecting that level. So it's a pretty reliable sign that you can take this down. But actually went to retest again. So leaving aside this structure for a moment, we are just taking in place this little one here. This is a double top here, and then it goes down. So here we have a break in the channel here. Then we have the resistance level, double top, rejection here, bearish bar, and it's an engulfing bar there. Then we can take the trade. 3 things. They always use at least 3 things, at least. But the more the better. The more confirmation I get, the better. Of course, nothing is 100% reliable. In trading and in life, nothing is 100%. But, well, it helps, to have more confirmation. The confluence of different factors and signals there that tell me that the trade is not going to fail. Okay, here we have another example here. And clearly downtrend. Check 1, 2, 3, 4 times. This is a consolidated downtrend channel there. Price action is inside there, and it's respecting the price action, the channel there. And at this point, it tried to close outside, and it closed outside. Breaks and close outside, come back in, breaks and and close outside, and then goes down. So here at this place, when it breaks the channel and closes outside, I know there's a potential change in trend taking place, because you know the bears here are losing power and the bulls are starting to pushing up harder. That's why this happens, you know, the break in trend. And if it doesn't break the trend, I usually keep on taking the trade, you know, here, entering and going down, entering and going down. And if it breaks, I know that I should not take this trade to the downside, because maybe it's going to take a turn to the upside very soon. Okay, so first signal breaks and closes outside. Second signal, when it identify the resistance support level here, which is at this point here, the lowest. And then it breaks lower. Clearly it goes through the resistance level, which is one of the three options of the possible outcomes of this method. At this point here, when it goes through, I use the Fibonacci price extension levels from the highest point where it closed outside here to the lowest point there. And there we have here a nice reaction to this 61.8% of the extension levels at this point here. Exactly. So first signal breaks outside, second signal price extension. There are two things telling me I can take the trade. The third thing I will look for, in this case I can see it very clearly, it closed outside the Keltner channel there. Or you can use, or you know, I also use sometimes the Bollinger bands, but you know, whatever you like, it will be fine. If it closes outside the Keltner channel, it usually tries to go inside again to the other side, because that's an extreme level there. So that's the third signal. It closes outside the Keltner channel and it's signaling me that maybe there's a high probability the prices start to going up. The fourth signal I have there, it's this moving average here. This is the 200 period moving average, and it tests that level once, tests that level twice, the third time there it goes. So, and the last thing I check will be the price action bar that tells me that, well, this is not very bullish, but considering all the other factors, also here the RSI is in a oversold here, oversold position, touching the blue line down there, and it's telling me, well, it's pretty oversold and maybe there's going to be a change in trend. So there are like four, considering all the confluence of these factors, 4 or 5 things, I take my decision. It helps me a lot in my decision process there to take the trade or not. And then I take the trade here. So I place my stop limit or stop market order one tick above this bar, the green bar there. I place the stop loss 1, 2 or 3 ticks below here. This bar is there, and it's pretty safe, I think, because you know here the 200 moving average coincides with the 61.8 level, and you retested that level 3 times, 3 bars consecutively there, 1, 2, 3. So it's pretty solid there. I take the trade there, and then it's clearly a change in trend. takes place there. And this will have been also a nice trade. Around how many points? 600 to 23 points in the S&P mini S&P 500 will be around $1,250, around a little bit less. That's how I trade this. The other way you can enter this type of trades is to, use not stop market or stop limit orders. You can use a limit order and wait for the next bar here to come inside trades, but not in. Okay, so let's take a look at an example of a trade I made. Okay, here I am trading the E-mini S&P 500 futures. I placed an order here, and well, unfortunately I couldn't draw the channel there, but there's a downtrend channel that goes almost parallel to that wide moving average there, and I placed my order there already, and I filled my order there at 3,234, and I took this trade mainly because I had a signal due to the law of vibration, and because it coincided there with, matched very well with a nice support level there in another higher time frame. So that's where my main reasons why I took this trade. We can see here the price action reacting to that level there, and I am using 8 ticks of stop loss, and the take profit, it's around the $300 mark, where my risk is $100. So risk reward ratio is around 3 to 1. There it goes. So yes, unfortunately we didn't draw the the channel in time. I have it in my other screen there, and I'm gonna move a little bit more the take profit to $425. And as soon as I'm seeing that nice green hammer down there, I have more confirmation that the trade is going to go up. And well, I'm just intending a scalp because he touched the inferior line of the trend channel. So I entered this trade there, and it coincided with the nice support level in another time frame, and with the signal of the low vibration, my other calculations that I have in the other screen. So that's why I took the trade, and I'm very confident it will go up at this point. And it's fighting there. That's why it's very not easy to take counter trend trades. And well, I'm pretty much not a momentum trader, but a contrarian trader, because I try to spot the best places where the trend is going to take place. That's what I do, a contrarian trader. And I want to take a small scalp out of this trade. And the first, my first target will be around that wide moving average there. and well, I'm gonna move here my stop loss, and at this point this is a risk-free trade, because in the worst case scenario not very positive. Okay, here we go. Here we go. Okay, we're out of the trade. Nice trade, $425. And at this point the price action is breaking out of the channel. There, so I know now that this probably is going to retest down there, try to retest down there the support level, and from that point there it's going to rally up, you know, to change the trend to the upside. So I'm going to wait for the price action to retest again, at least. Okay, a few minutes later we're here, and I want to take the trade here again at 3,231.25 cents, and here we go. Already enter. I'm gonna move a little bit my take profit. Oh, it's so fast. I didn't have time even to move my take profit. It took me out of the trade. Well, $150 there in less than 30 seconds. Very fast, impressive. And this happens there, you know, that big green bar there happens because most of the traders were waiting for that confirmation of the double bottom there. Yes, double bottom there. And as soon as it made there and touched down there, almost all traders entered the trade, and that's why it made the explosive movement to the upside. And we see a very big engulfing bar, bullish engulfing bar there to the upside. So that's you know, very nice, and that's confirming the trend is changing. Unfortunately, well, it took me out before I had planned. At least I would, but it's okay. That happens in trading all the time. At least if we are winning, if I am winning, it's okay. So well, I'm happy. 2 good trades in a couple of minutes. That was nice trades. Well, okay, if you like this video, give me a like and subscribe to my channel for future videos about trading and the law of vibration.